What if you could buy your next rental property without showing a single pay stub? What if your W-2 or your latest tax return never even entered the conversation? Imagine a world where the property itself does all the heavy lifting. A world where the deal stands on its own 2 feet. That world is real. And it's powered by a special type of financing called a DSCR loan. This isn't some secret handshake for the ultra-rich. It's a tool designed specifically for real estate investors like you. It's for people who understand that a good rental property should pay for itself. DSCR loans shift the focus entirely. They move the lender's magnifying glass away from your personal bank account. They point it directly at the property's ability to generate income. This is a game changer for so many investors. It's for the self-employed entrepreneur. It's for the seasoned pro. It's for the ambitious newcomer. This essay is your guide to understanding how these loans work and why they might be the key to unlocking your next deal. Let's break down that scary-sounding acronym. DSCR stands for Debt Service Coverage Ratio. It sounds like something you'd hear in a stuffy corporate boardroom, right? But the concept is incredibly straightforward. It's a simple math equation lenders use to measure a property's cash flow. It compares the property's rental income to its monthly debt payments. The debt service is just a fancy term for your total mortgage payment, often called PITI, principal, interest, taxes, insurance, mortgage $1,500 per month, rent $1,800 per month. To find the DSCR, divide income by debt. 1,800 divided by 1,500 equals 1.2. That means about 20% more income than needed to cover the mortgage. It's a cash-flowing property, built for real estate investors, not for your primary residence. These are exclusively non-owner-occupied investment properties. The magic number is often 1.0, but lenders usually want higher. Common minimums are 1.15 or 1.25. Higher DSCR equals less risk for the lender, and often a better deal for you. It's about proving the property can stand on its own. The property itself qualifies for the loan, not you. Say that out loud. The property qualifies. When a lender underwrites a DSCR loan, they are playing detective. But they aren't investigating you, they are investigating the property. Their entire focus is on the asset and its ability to perform. First and foremost, they need to verify the rental income. If the property is already occupied, the lender will ask for a copy of the current lease agreement showing the monthly rent. They may also ask for proof that the rent has been paid on time. A solid lease with a paying tenant is gold. What if the property is vacant? No problem. This is where an appraisal comes in. The appraiser determines market value and completes a comparable rent schedule, what similar nearby properties are renting for. They use comps to establish a fair market rent for your property. Next, the lender calculates the debt part, your proposed monthly PITI. They add principal, interest, taxes, and insurance into one total monthly housing expense. Then, they divide verified gross rent, lease, or appraisal by total PITI. If it meets their minimum, say 1.20, the deal has proven it can support itself. It's all about the numbers. There's a reason seasoned investors get a little giddy when they talk about DSCR loans. The number one benefit is the freedom from personal income documentation. No more digging up tax returns, scrambling for pay stubs, or writing letters for every deposit. For self-employed investors, freelancers, or business owners, this is a massive relief. With conventional loans, every new mortgage inflates your DTI until you hit a ceiling. DSCR loans sidestep this because qualification is based on the property's income, not yours. This lets you acquire property after property, as long as each deal makes sense on its own. Approvals can be faster. DSCR lenders focus on appraisal, rent analysis, your credit score, and down payment, cutting weeks of underwriting. They create a clean separation between personal finances and your investments. Each property is its own self-sustaining unit. Bookkeeping gets easier, and you can track performance clearly. The property stands alone. This financial discipline is a hallmark of successful long-term investors, a true business, not expensive hobbies. As DSCR loans have grown in popularity, a few myths have floated around. The biggest myth: you don't need good credit. This is not true. Lenders still look at your credit. Higher scores usually mean better rates and terms. A low score can make qualifying hard, or lead to a much higher rate. Another myth: any rental property will qualify. False. The property is the star of the show. It has to be a star performer. Poor condition in a weak demand area won't fly. Location and market rent must satisfy the lender's DSCR requirement. If market rent is too low versus price and PITI, the math won't work. The deal has to be solid with real positive cash flow potential. Myth 3. DSCR loans are just for experienced, wealthy investors. Not true. They can be amazing for newer investors with good credit and a solid down payment. There's also the idea they're always riskier or have terrible rates. Risk is relative. A well-structured DSCR on a strong property can be safer than a conventional loan on a borderline deal. Rates are often slightly higher, but you pay for speed, flexibility, and no income verification. For many investors, a small rate premium is worth acquiring great assets and scaling faster. It's a business trade-off. When you're financing an investment property, you generally have two main paths: a traditional, conventional loan or a DSCR loan. Let's put them in the ring for a head-to-head comparison. Biggest difference: income verification. Conventional lenders scrutinize W-2s, tax returns, and pay stubs to calculate DTI. DSCR barely glances at personal income. It focuses on the property's rent. Most conventional programs, think Fannie Mae, Freddie Mac, limit mortgages per borrower, often around 10. Once you hit that wall, it gets hard. DSCR loans have no such hard limit. Each DSCR loan is underwritten on the property's merit. Bring profitable deals, and lenders keep lending. Conventional rates may be slightly lower since they vet your personal ability to repay. DSCR might run a fraction to a full point higher. Down payments differ. Conventional sometimes 20%, DSCR often 20 to 25%, even 30% in some cases, lowering risk and easing DSCR math. DSCR lenders are specialized, non-bank, and nimble. Streamlined docs mean faster closings. Speed becomes a powerful negotiating tool. Traditional loans can be slow and paperwork heavy. DSCR loans are built to finance good rental deals quickly and efficiently. A tool built by investors for investors. We've covered a lot of ground, demystified the acronym, explored the lender's playbook, and busted the myths. Now it's time to turn this knowledge into action. The theory is great, but real estate investing is a contact sport. You build wealth by doing deals. The beauty of the DSCR loan is that it simplifies your mission. Your job is to find a property that proves its own worth through cash flow. First, find a promising property in a solid rental market. Do your research. Understand the local demand. Second, run the numbers relentlessly. Estimate pity, get realistic market rent, and make sure rent comfortably covers the mortgage. Aim for at least 1.2 DSCR. Third, talk to DSCR lenders. Ask about credit score, down payment, and reserves. Compare full packages, fees, closing costs, and required DSCR. A specialist loan officer is a valuable partner. When you've got the right deal and partner, submit the application, get the appraisal, close the deal, then manage it well. What if you could buy rental properties without your personal income being the deciding factor? You can. DSCR loans make it possible. They reward you for finding good deals. They let the property qualify itself. They put cash flow at the center of the universe, right where it belongs. So stop letting your W-2 dictate your future. Be smart, do the work, and go build your portfolio with confidence. Let the property do the talking.